So in this case, I'm simply talking about classification. Let's have a look through our classification options. We'll start with assets. And if we have a look here, you can see that assets break into current and non-current assets. Current assets are typically assets that have a life cycle of something under 12 months. Things like, for instance, accounts receivable. So accounts receivable and anything like cash, inventories, other receivables like rents receivable, current retentions on building projects, that sort of thing. Typically, non-current assets have life cycles longer than 12 months. Things like, for instance, financial investments, which might be like share investments, that sort of thing. Fixed assets, any of those sort of fixed asset items that you would typically depreciate, plant and equipment, land and buildings, motor vehicles, that sort of thing. Any loans, so long-term loans that are going to have a life cycle longer than 12 months. You see that we've got loan breakouts for associated persons, and then just sort of any other loans which might be related to non-associated entities, companies, etc. Non-current retentions. Term receivables. Term receivables would be receivables that have life cycles longer than 12 months. Unexpired capital costs, any of those sort of costs of setting up the business. Those would be your preliminary expenses, and there are tax rulings on how you can depreciate these things at an accelerated rate, so watch out for that. So that's your current assets. And essentially what you're doing, very easy, you've got current assets, CBA. You just look and see where you'd put that in the classification chart. So maybe that's a bank account, and we know that that is, right? Or you could do it like this. Just type in the word bank. So as long as you know the naming conventions on our taxonomy, you can easily use predictive text. It's a whole lot faster, and you can whiz through. Noting that most of the classifications are perfectly accurate, and the reason that they're perfectly accurate is because we do have a machine learning algorithm that we fine-tune from time to time. So let's dive into liabilities. Similar sort of structure to assets. You've got current, non-current, same kind of concept there. Less than 12 months, more than 12 months, generalized. So accounts payable, that's probably your most common. That's all of the suppliers that supply your business with goods and services. Accrued expenses, typically accrued expenses are where you haven't received the invoice from the supplier, but you know you've got a liability at the end of a given time frame. So you just make an accrual. Deferred income, you've collected the income from the customer, but you've collected it in advance. So that's really income in advance. Employee payables, things like, for instance, you might have some wages you haven't finished paying. Government taxes, you'll see we break these out quite specifically into all the different tax types you could possibly have. Leases, so if you've got lease payments outstanding. Loans outstanding, and you'll see within the loans category here, we've also got bank overdrafts, which we treat as a kind of a loan, current loan, credit cards, type of a current loan, any of your unexpired interest and outstanding payments for current hire purchase component, because typically with hire purchase, you're going to break your hire purchases into two parts, the current unexpired component and the longer term, more than 12-month component. Noting that we do have hire purchase calculators here and reports here where you can see both the current and the non-current components if you wish to break out your hire purchases. Not everyone does. Typically for smaller businesses, it's not such a big deal if you don't. Provisions, any sort of provisions that you're making for future liabilities. So we're still in the current liability section here, right? So current liability. Superannuation payable, noting that any super unpaid at the end of a particular financial year is not deductible, but the super that you've paid for the end of the prior financial year would become deductible. Non-current liabilities, so again, accrued expenses, this is probably quite unlikely. I mean, typically these are going to be current accrued expenses, which I described previously. Debentures, very uncommon. Long time outstanding deferred income, uncommon, unlikely. Deposits and holdings, anytime you're holding money on a deposit, and you're going to keep holding it maybe for a long term, when you've got maybe a property which has been rented and you're holding the deposit on that. Leases, again, are long-term leases. Loans, again, we break the loans into, these are loans, a liability perspective, so these are loans that your business would owe. So hire purchases, if you want to learn more about hire purchases, we've got some knowledge content on that. Loans from associated persons, the reasons that we break out loans from associated persons from other loans is because there could be Division 7A complexities with loans in relation to associated persons, associated companies. Any sort of other you'll notice in all our sections we always have an other. So if you can't sort of categorize it, just stick it in there. Provisions, again, I've described provisions, and retentions is to do with the building trade, where there might be some monies held over for a long time frame until the buildings sort of pass through a five-year or maybe a 3-year testing period to make sure that nothing breaks, nothing falls apart. So back to the classification, we're into equity now, and let's go through what we have in equity. Equity, you'll notice, is contextual to the type of entity that it is. So for a company, you'll have reserves, share capital, retained earnings. Within your retained earnings, you've got your current earnings, any dividends that you pay out. Dividends always get paid out of retained earnings. Any historical earnings. Historical earnings is whatever rolls forward from the prior financial year. It could be losses as well. And same for the current year, could have losses in the case of a company. So just note that with respect to classification, there are some differences when it comes to equity. Obviously, every company typically has share capital. And if you're transferring money out of your retained earnings or transferring value out of your retained earnings to reserves, you've got the transfer out, so you can record against that. Into the revenue section, revenue breaks into trading, investment, other, and grants. So any government grants you put through there, those might be taxable, non-taxable. There's tags that we'll get to in a moment. Any sort of other revenue not directly related to trading. Fringe benefit adjustments, for instance. So if you're not preparing a fringe benefit tax return, you're a trust or a company and you've got benefits to directors or beneficiaries, then you can report your fringe benefit income. So there's a method and some learning that you'd need for that. Increasing balancing adjustments, that's for profit on disposal of the depreciating plant. Insurance recoveries, you could see we've got categories for all those things. Investment revenues will be things like, for instance, dividends, forestry management, investment scheme income, interest, rental income. There is, except for in the case of a company, trusts, individuals, partnerships, there's special sections for the rentals. Royalty income, partnership income, share of trust income. This is always on the accounting side, and there could well be differences on the tax side. So just make sure that you classify up your accounts and then consider if there's a tax return for partnership on the other side, that the partnership taxable income flows through to the company. All those other income types. Expenses. So we've got a breakout between direct and indirect. Direct costs are if you're operating a business and the costs vary directly with the amount of activity that you do. You treat them as direct. Whereas if you have a typical business where, let's say you've got rent, doesn't really matter how much business you do or don't do, you always have the fixed rent every month. That would be an indirect cost. But if you're in the business of freight and cartage, definitely your fuel and oil is going to be related to the amount of business you're doing, and that would be a direct cost. So let's just have a look through here. We've pretty much got everything that you could need, including categories. If you want to break out your cost of goods into your opening inventory, closing inventory, and purchases, you can. We've got all the categories that you would want if you were in primary production or if you had factories. If you're a restaurant owner or your business is involved in restauranting, consider that you need to put in tax calculation value for goods taken for own use. Human resource costs, you can really break out and put your human resource costs either as a direct or indirect cost. Motor vehicle costs, same again. If you're in the trucking game, probably your vehicles are direct costs. Farming, you've got everything like, for instance, spraying and chemicals and washouts. Down to indirect costs, all your typical categories, accounting fees. I'll just rush through this. Comprehensive expenditure, really shouldn't be using this if you've got a small business, you won't have this. This is just your increasing and decreasing adjustments. Computer expenses, depreciation. If you want to do depreciation on a tax basis, we've got categories for all your tax depreciation. It is common for small businesses to just put their tax depreciation into their accounts. It makes life simpler from some perspectives. Human resource costs. Note that we categorize human resource costs, including salaries, wages, and superannuation, into this category. If you're generating reports, you can always break those out and keep them separate. You don't have to have this categorization for your reporting, but at least for the categorization at this stage, we do have the section in our taxonomy. Motor vehicle expenses, if you want to break those out, we really only worry about two categories: vehicle lease costs and other. So in here you would have things like, for instance, fuel, repairs, rego, that sort of thing. Categorize all those line items under there. Rental property, as I mentioned, with trusts and partnerships, you will have to report each rental property. So these categories map and match to the rental property categories in the rental schedules. Just note that with both the trust, the partnership, and the individual, even if you classify rental property costs and revenues, you will still have to manually plug those values into the tax returns. We don't yet have the capability to have those mappings go directly into the correct sections of the tax return in that case. Tax expenses, this is your income tax expense down here, right, typically. So you would classify, if you've got a company and you want to record your tax liability, credit your tax liability, debit the expense, and classify the tax expense in here. You'll see it report correctly in the tax return, so it won't get treated as a deduction. So again, very easy. You can see these map automatically, but let's just say that went like that. Easy again, just to type it in, and you've got your categorization. So again, depreciation, and then choose which type of depreciation. So general pool, and there you go.